Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show, and today I'm pleased to welcome back Eric Balchunas, Senior ETF Analyst at Bloomberg Intelligence, to the show. Eric, how are things?
Hot. I'm in Philly and it's 100 degrees. It's like Texas up in here for the past couple days. So the market and the ETF market is equally hot. So I'm sweating and busy.
Got it. Sweaty and busy. All right. Well, let's start there. I mean, it's been about 10 months, I think, since I've had you on the podcast, which is kind of an eternity in this business. So let's talk about that corner of the market. I mean, what are some two or three of the things, the biggest developments you're seeing in the ETF space right now that are most noteworthy to you?
Yeah, look, the big blob of flows, like 70% of it still goes to S&P 500, the Qs, the total market. So this sort of like passive wave is alive and well. We just don't cover it a lot because it's boring. What else can you say about VOO? Tracks the S&P, it's 3 basis points. Like, we got to move on. But the S&P is up 18% this year. That is enormous. I mean, it's only averages 8-9% a year. So I'd say number one trend is just chunk of money going right into cheap beta as usual. We just take it for granted. Now, the other 30% is what we cover the most, which is where else is the money going? Because everyone wants to know, our clients in particular, like what works, what doesn't. Investors want to know what's hot, what isn't.
Yeah.
So our two big themes is boomer candy and hot sauce. So I'll explain. Boomer candy is like ETFs that use options to target your outcome and like make you sleep at night. Like if you're an older investor, you want to be in the market, but you're nervous that you don't want to lose your principal. And because the aggregate bond index, like the AG, has not really hedged stocks. Like in 2022, it went down also, and
Yeah.
it hasn't kept up with inflation. And I think it's like flat over 10 years. People are like, what can I put in the 40 to help hedge my 60? So they're turning to these option-based strategies that limit your downside, either through targeting the outcome through flex options, or writing call options on top of exposure to the S&P, which gives you a huge income for the option premium, which buffers your downturn if there's a downturn. That's like a JEPI.
Yeah.
So those two things are very popular in terms of finding a niche. And also a lot of issuers are jumping in now. So there's like 12 issuers now who have these sort of buffer and or covered call strategies. And then the hot sauce is more for the younger crowd and maybe the older crowd, but it's like, okay, I got my 60 and my 40. I've got the whole like nest egg taken care of, but it's kind of boring. I got to sit here and just wait. It's like watching grass grow or maybe even paint dry. And they want to have a little fun. So there's this, 2 to 15% of the portfolio that people use for stuff that gets their blood flowing. So this would be like, ARK was a good example of that. Thematic ETFs, leveraged single stock ETFs have been a big hit. Crypto, I would put in the hot sauce bucket. And these are just things that are highly volatile and have nothing to do really with your core. And there's a big legit market for those. And in both those cases, hot sauce and boomer candy, the issuers can make much more money. They don't have
Yeah.
to compete with Vanguard or anything. So they charge well over 50 basis points, if not close to 1%. And so that's where the bulk of the products have been in those two areas. But still, the bulk of the flows are in the boring beta stuff that's from Vanguard and BlackRock that's been around for 20 years, but is kind of boring to talk about.
Yeah. Let's unpack a few of those things. You mentioned the fee issue. I know that you tweeted recently about how high fee ETFs, or high fee relatively speaking, those charging 50 bips or more, were proliferating. And is that what it really is? Just funds that are geared at those types of investors you're talking about?
Absolutely. So if you look, because nobody's launching a cheap S&P 500 ETF to challenge VOO and IVV. I mean, it'd be like a suicide mission. The other thing is, when it comes to the core of the portfolio, advisors have shown they love brand names. So it's not enough just to be cheap, and we got to be cheap and a brand name. So they're just going to pick BlackRock, Vanguard, or State Street probably. So you can't win there. So there's no cheap ETFs being launched. I will say there's a couple cheap ETFs from like DFA and Capital Group that are like low tracking error active, and cheap meaning 35 basis points. So active has gotten lower fee, and I'd say they're cheaper, but the average fee of a new ETF is well over 50 basis points, and that's because of the boomer candy and hot sauce. Those areas, I'd say the average ETF that's boomer candy comes out at like 70 to 90 basis points. and hot sauce can be like 80 to 120. The only caveat there is the Bitcoin ETFs, which are ironically really cheap, probably because they did have BlackRock and Fidelity in the mix. Normally, those other two places, you don't get those big guys in there lowering costs that quickly. But BlackRock entered the Bitcoin race, and there was a huge fee war before they launched. So that's a rare case where you get hot sauce on the cheap, which is partially why I think they're so successful. You can get those for 20 to 30 basis points. But
Got it. Yeah.
but
Go ahead.
just one thing on that. So even though the average fee of a new ETF is going up, the flow weighted fee, if you flow weight or asset weight the fees, that's going down. That's how much money is flowing into 3-4 basis point beta, that it is bringing the flow weighted average fee. So the average ETF fee now is around 50 to 55, 60 basis points because of some of those hot sauce. But the asset weighted fee is about 19 basis points. And the flow weighted fee is going to be around 15. Makes sense? So the more you weight it by like what people are buying, the cheaper the average gets.
Now, do you think this trend of people playing around in the active space a little bit more is going to continue? I saw Morningstar just had that report. I think it said actively managed ETFs got about 25% of the flows in the first half of the year, even though by their count, actives only account for about 7% of assets.
Yes, but it's not your grandfather's active. This is not Peter Lynch picking stocks. He's so smart active. A little bit of that, I'd say a quarter of it is just straight stock pickers, like a Capital Group's having some success. They're like classic stock pickers. But like the buffer ETFs, JP Morgan, JEPI, JEPQ, those are active, even though they kind of have this like, system that you could probably make into an index. Like no one's buying JEPI for the PM stock picking skills. They're buying it for the covered call strategy, which gives them that big income. So that's one. And then the single stock ETFs are all active. So some of the active, the flows into active have been these more niche, structure-y kind of products. That said, the traditional active stock picker is doing way better than it ever has. And largely it's because it finally got below the all-important 40 basis point threshold. If you're not going to be Cathie Wood and hot sauce and trying to shoot the lights out and vying for that small percent of the portfolio, but you'd rather actually try to be the core of somebody's portfolio and you're active, you got to get cheap. So what we found is that as they gotten cheap, they've readjusted their fee to account for how much beta is in the fund. So for example, if you are mostly holding like S&P stocks, but you have slight tilts, you have to have a low fee, because an advisor looks at that and goes, I can get beta for free. Why am I paying you to hold at Amazon, JP Morgan, Google? So that's DFA and Avantis have really lowered fees because they have low tracking error. JEPI's kind of in the middle, 35 basis points, but it's got a little more active share. And then Cathie Wood's probably a good example. She's 75 basis points, but she has 95% active share. So if you beta adjust your fees, it's starting to work. I think advisors just want to pay for the active, not the beta. And now if anybody who readjusts has a fighting chance for flows.
Let's shift gears here for a little bit. I mean, this market rotation, holy cow, in the last week or so, this out of tech into a lot of other things, small caps in particular, do you think this kind of rotation is going to continue? And what do you think that's going to mean in the ETF space? I mean, obviously so much money has been flowing into these concentrated ETFs in tech, right?
Yeah, no, it reminds me of the Eagles. This is definitely going to be the Eagles year. I'm a Philly fan. I feel like we've been saying this about small caps for 15 years. Same with international. At some point, it will be like a regime change, but it's hard to tell. My boss, actually, who runs all of equity strategy, Gina Martin Adams, has this phrase called the 493, which is the 493 that aren't the Magnificent Seven in the S&P 500, and how their earnings growth is actually growing. Like if they can keep this earnings growth trend, and consensus says it will happen, that's a good sign that the other stocks will catch up to the Magnificent Seven. That's good for value. That's good for other sectors. That's good for equal weighting, right? Because now the only thing that's really worked is heavy market cap weighting with Mag 7, like, overweight. Yeah. So if the 493 can get going with their earnings, that should help, honestly. And the 493, I would say, are small, large caps, but that would apply to the small caps as well, the mid and small. But I am actually watching the equal weight S&P 500 because that would give every stock equal weighting. So if the 493 play catch up, equal weight should outperform the S&P market cap weight like SPY in the second half.
Yeah, okay. Let me ask about a couple of other kind of semi-niche categories. Gold ETFs, fund flows there. It's kind of interesting to me that you've had a great year for precious metals, but unless it's happening now, with this latest move, there hasn't really been much excitement or money flowing into that sector, those ETFs, right?
Yeah, not really. I mean, I'm going to look real quick. What is gold up this year? It's probably up, what would you say? 10% maybe?
Yeah, I mean, we're silver
16%. That's not bad.
Yeah.
The problem is the S&P is up 18% and Bitcoin's up like 38%. That's the problem. So if you took Bitcoin off, you might see some gold people, people hedging just in case there's a sell-off. But now gold has this sort of young buck competitor for store of value in Bitcoin, which I consider to be gold as a teenager. It's like gold in like year 600 when it was like stealing your car and like talking back to you and like very volatile. Gold is like an ancient old man now. It barely moves. Bitcoin is all over the map, but they serve the same purpose. So I think that's part of the problem. Gold's just being outshone. And the market, if the S&P tanked, I think gold, that would help gold a little.
Yeah.
It's interesting though, if the market tanks, it's possible Bitcoin tanks with it. Bitcoin's kind of a risk asset still. Gold is a legit alternative. It has zero correlation, and it's possible that would really help gold. If everything just went in the gutter, including Bitcoin, that's when gold could sort of come back. But right now, it's just overshadowed by everything.
Yeah. Yeah. Okay. And since you mentioned Bitcoin, obviously it makes sense to kind of segue into what you've been saying about the Ether ETF situation there. What does this signify in terms of crypto's acceptance? Is this going to be a process that continues throughout that space, or how do you think that unfolds?
Yeah. So the Ether ETFs are launching next week, and they're going to be, another like Kentucky Derby style race with like 8 issuers. And to me, that's good. The competition, all these issuers are now going to get on the horn and call their friends and family and say, hey, can you buy our ETF on day one? Because they all want to get out of the gate looking good. So that competition, I think, helped the Bitcoin ETFs raise money early. And I think it'll help Ether. But I just don't see Ether getting as big as Bitcoin. Our estimate is maybe 20% of the interest. I think it'll have a relationship of silver to gold. Ether's also more complicated to explain. Yeah. Bitcoin is digital gold, done. Boomers get that. So we'll see. But it's interesting now that Ether is out. They've filed for a Solana ETF. That to me is going to depend on the presidency. If Trump wins, I mean, the floodgates could open even beyond Solana. If Biden wins and we get Gensler Part 2, it's over. ETH will be it for a long time. So still, though, having two, Bitcoin spot and ETH spot is really good. I mean, especially under this SEC. That's it actually happened. It's good it happened, in my opinion. How far do we go? How far should we go? Those are open-ended questions beyond that. But I do think that the thing that people are underrating, in my opinion, is someone like Larry Fink. BlackRock's going to have a Bitcoin and Ether ETF. He goes on CNBC and Fox Business regularly and says, Bitcoin's, he goes, I wasn't a believer. I'm into it. Here's the purpose. Yeah. He gives a lot of regular people, 60-40 types, boomers, advisors, cover and comfort and fidelity. And even Franklin, Jenny Johnson, CEO of Franklin, is really into this. So the more of these like traditional FI legacy, gigantic asset managers that sort of come around on Bitcoin, I just think it's hard to really be bearish on that because they have so much distribution firepower and they really give advisors cover. If there was only the ProShares Bitcoin Futures ETF, that's a little more risky for an advisor to go into that and it goes down. And then they're like, who is even ProShares anyway? Yeah. But now that it's got BlackRock or Fidelity in the name, that's a lot more security for those advisors. And I think that's an underrated point and why we're pretty bullish on the category.
Before we get to wrapping things up, you've talked about Larry Fink, we talked about BlackRock here. I mean, they had what, record ETF flows, $83 billion or something, $57 billion in June. I mean, is there anything that stops the big from just getting bigger here? And are there any implications for investors in the space?
Yeah, so we have a theme called the other guys. And if you look, ETFs that aren't the big three took in 45% of the flows last year. That's a record for them. They took in 20% 5 years ago, because the other guys are now getting like Morgan Stanley, JP Morgan, like Capital Group, right? These are gigantic companies. So the other guys are probably going to keep a lid on BlackRock and Vanguard, 66% market share. So I don't know if that'll go down, because they tend to they punch within their weight now. They used to punch above their weight, but I think they're going to punch within their weight or slightly below it in the future, because I think there's 350 other issuers now, and that number, and there's 600 brands, because some of them have two different brands. So those 300 issuers will go to 400, and some of them are big, and they're going to put a ceiling, I think, on BlackRock and Vanguard. The market will handle this to a degree.
Yeah.
But I just don't see Vanguard and BlackRock not getting theirs on a consistent basis, because, like I said, if you poll advisors, the two most important things to them are fee and brand. And those two firms have both of those in spades across your whole 60-40. So it's going to be tough. But these other firms are, as a unit, the other guys are going to get theirs.
We're talking because you're going to be joining us for the Orlando Money Show event that's coming up in October. Obviously, 3 months out, anything can happen in the markets between now and then. But any sneak peek you'd like to give or suggestion about what you think you're going to be covering there?
Yeah. So, I talked to you about what the two big trends this year that happen outside of beta. And so I'm focusing just on the hot sauce, and I'm calling it the many flavors of ETF hot sauce. So I'm going to go into leverage, thematic, single stock ETFs, these max yield boosters, which give you like 100% yield a year, crypto. And I'm just going to tell you the good, bad, and the ugly, because I think when I go to the Money Show, I think investors there are looking for the latest and greatest, like the new gadgets. They kind of know what like an index fund is. They don't need a whole tutorial on that. So, but the hot sauce is where all the innovation is happening. So I figured that's good value of my time there, is just go through some of the tickers, what they do, and just let people know, what they're getting into, because every flavor of hot sauce does have risks that people should know about. I'm fine with it. I'm okay with it. I just want to do something that, gives people the full range of things to think about before buying some of these products.
Perfect. Well, Eric, thank you so much for joining me and for sharing your insights. Viewers, if you're watching this again, Eric's going to be joining us for the Money Show Traders Expo Orlando. It runs October 17th to 19th at the Omni Orlando Resort at Champions Gate. If you like hot sauce, you'll love it there. If you like golf, you'll love it there too. You're going to pick up a lot of information you can put to work in your portfolio. So, Eric, thanks again for your time. Appreciate it.
Yeah, thank you. Pleasure as always.